So this video is going to walk you through Chapter 6, Example 3 in the outline. Let's head over to Step 1, and as you'll notice, on the left-hand side of the screen, I've actually included the question, so we can see where some of these numbers are getting pulled from. So, purchase price. It is stated right here, it was $225,000. So let's enter that in. Next, we need to figure out the implied purchase price. How we do this is take the purchase price divided by the percentage of ownership, which was stated at 90%. Next, we need to go and figure out the book value of our net assets. Well, how we want to do this is we want to take our value, and I'm just going to scroll down here, our common stock of $150,000. plus the information we were provided up here of $56,000. That is their retained earnings when they acquired, or when they purchased these shares of Spandu. Next, the acquisition differential is the difference between these, the implied purchase price and the net book value of the assets. That gives us $44,000. In the question, it states that the acquisition differential was entirely allocated to copyrights with a 10-year life. So fair value increment is $44,000, which really means that the goodwill will be 0. Next, let's go on to Step 2. We need to figure out the acquisition differential schedule for that copyright. So of course our opening will be the amount as shown above, $44,000. As it is a 10-year life, we can figure out years 1 through 5 by a formula, which will probably be 44,000 divided by 10 times by 5, 22,000. We also need to figure out year 6, so 44,000 divided by 10. I'll just give us 1 year's worth. The closing will be the opening amount, less the 5 years, less year 6. That gives us a total of 17,600. Now, if we had more line items, I would be listing them underneath here, but as we don't need to just copy it for the sake of copying it, but I do think it's important to color code these entries. So this is going to be hitting the subs opening retained earnings. This will be impacting our subs adjusted net income. Then the final is the subs adjusted net assets. Now, to be consistent with the color coding, this we are going to be with red. This is going to be color coded yellow. These ones are both green. And lastly, our closing is blue. Next, we are on to Step 3. In Step 3, we need to account for all of our intercompany transactions. So let's approach the easiest one first, which is dividends. The information we were provided is actually down here for the dividends for Spandu. They overall issued 20,000. Remember that we only acquired 90%, so we want to take that into consideration here. So overall, 18,000. This is going to be hitting our parents' adjusted net income, and that is a color code of green. The 18,000 is also color coded yellow. Of course, after that, we have our intercompany sales and cost of goods sold. Before we're able to type in our final figure here, we're going to need to figure out some information, and primarily focused on our purchases. As Palaver purchases its entire inventory from Spandu, so we need to figure out what that figure is. We know our opening inventory amount as it was provided in the case right here. So let's jot that down. Next, we need to add our purchases. Well, that's the figure we're looking for, so we can't include that quite yet. We're going to have to work our way backwards to it. Next is our COGS. Our COGS are presented on our income statement over here, so we know that one. As it is a deduction, I'll just put it as a negative, 201. And lastly, our closing inventory. We have that figure here as well, which is 80,000. So now we need to figure out what is X, which is our purchases. So in this case, what I suggest we do is insert a formula here. So that will be equal to our 201 plus our 80,000, because we're trying to sort of work our way backwards, less that 44 opening. So you can see here the math does work out. If we hover over it, these add up to 80,000. So now we know the amount of our purchases, but we still also need to capture the amount of our cost of goods sold. So the cost of goods sold figure in the question, right up here. So it says that they purchased the inventory from Palaver in the amount of 145. So intercompany sales is a combination of these two figures, 237 plus the 145. Total combined amount of 382. Just going to highlight that one yellow because we'll be needing it in a little bit. Now on to the intercompany profits. This can be very overwhelming at first, so let's take it slow. In the question, it mentions that we have recorded a gain of 13,000 on the sale of some land, and it was Palaver who sold it to Spandu. Now they still have that land, and it's just recorded as other assets or part of their other assets. So they haven't really done much with it, so we don't necessarily want to recognize profit from it, but we do need it to be adjusted for our books. So, of course, before tax, it will be that 13,000. Now remember, any capital items need to have their cap gains taxed at the appropriate rate. So we can't just grab the 40% like we were provided in the question. We need to factor in it's only going to be half of that. So the tax is going to be equal to the 13,000 times 20%. And of course the after-tax value is going to be the difference between the 13,000 and 2,600. Now before we go on to the next one, let's color code these. We are going to be hitting our balance sheet for these ones and our statement. Oops, I don't want to color that. Let's just reverse that. Wrong drop down. There we are. Next, let's move on to our upstream transactions. Let's first start with our beginning inventory. Well, you can see here in the question it tells you that their beginning inventory was 44,000. And it also gives us information about their gross profit on sales. So let's enter our formula. 44,000 times 25%. Now for the tax, we're able to take the full 40%, so times that by 40%. And of course, the after tax is going to be the difference between 11,000 and 4,400. Now let's color code these properly. So our COGS, it is going to be yellow as it's impacting the income statement. Our tax expense, also an income statement item. Then our SANI is green, and our SOR is red. Now let's calculate the upstream portion of the ending inventory. So we can see here it's 80,000. Remember that we are still applying that same average gross profit to sales of 25%. So 80,000 times 25%. Next, we need to take tax. Still use the full amount. And our after tax is just the difference between the two. Of course, we get to do some more color coding. COGS and tax expense are income statement items, so let's grab those and color them yellow. Our inventory and deferred tax are balance sheet, so let's color those blue. SANI is going to be green, along with SANA is also going to be green. Now it's time to take a peek at these downstream transactions. The first one, it tells us that Spandu had unsold inventory purchased from Palaver in the amount of $30,000 at the beginning and $40,000 at the end. So these are the figures we're going to want to be using. It also gives us a different average gross profit on sales, so we need to factor that in. So 30,000 times the 41. Remember the same tax rate between the companies in this particular example. That won't always be the way. And the final is just a difference between the two. COGS and then tax expense are both income statement items, so let's color those. Our penny needs to be green. Oops, let's try this again. Green. And our pour should be red. This one we knew to be 40,000 timesing our rate. And one last round of coloring. And our penny will be green. So that is all of step 3. This is the biggest area where students struggle, so pay a lot of attention to it. And if you need, don't be shy to come out and reach me, see me in my office, and we can work through a few extra examples together. So this is the end of one of a few videos for this question. Please see the second one to continue step 4.